Picture this. You are up on a quiet Sunday night. You tell yourself you will only check the market for a minute. A position that felt smart on Friday is now down hard in the overnight session. Your chest tightens. Your hand hovers over the button. You are not asking what is true. You are asking what will stop the pain. That moment is the psychology behind trading decisions in its purest form. Trading is not a battle of IQ. It is a battle of emotional regulation under uncertainty. Uncertainty means you can do the right thing and still lose, because outcomes have randomness. Most people say they understand that, until the loss is real and the screen is red. I want to start with a simple idea. Your brain did not evolve to manage probabilistic bets with instant feedback. It evolved to survive threats, seek safety, and avoid social shame. Markets press every one of those buttons. When price moves against you, your mind treats it like danger. You get stress chemistry. You narrow your attention. You want action. In risk terms, this is when your decision quality collapses right when your exposure is highest. A lot of trading errors come from confusing volatility with information. Volatility is how much prices wiggle around. It feels like a message. Often it is just noise. Noise is random variation that does not help prediction. The problem is that noise still triggers emotion, and emotion still triggers action. So people overtrade, they chase, they revenge trade, they flip from system to system. They are not reacting to edge. Edge is positive expected value, meaning your average outcome over many trades is positive. They are reacting to discomfort. Loss aversion sits at the center of this. Loss aversion means a loss hurts more than an equal gain feels good. In trading, it creates two classic behaviors. People cut winners too early to lock in relief, and they hold losers too long to avoid admitting they were wrong. That is not a character flaw. It is a normal human bias. But in markets, it becomes a structural disadvantage because trends often pay by letting winners run, and risk control often pays by cutting losses quickly. Jesse Livermore is often remembered for big wins and big blow-ups. I'm not going to romanticize it. The lesson is psychological. He could read the tape, he could sense crowd behavior, but he still struggled with sizing and with the urge to press at the wrong time. Position sizing is how big you bet relative to your capital. It is not a detail. It is the main control knob on your emotional stability. If you bet too big, you do not just increase risk. You change who you are while the trade is on. You become someone who cannot think. This is why I talk so much about drawdowns. A drawdown is the drop from your peak account value to a low point. Drawdowns are not just math. They are identity threats. When you are up, you feel competent. When you are down, you feel exposed. The deeper the drawdown, the more you crave a quick fix. That craving is where bad risk decisions are born. The market also weaponizes hindsight. Hindsight bias means after the fact, the outcome looks obvious. You look back at a chart and you see a clean move. In real time, it was messy. There were headlines, gaps, fake outs. Hindsight makes you overconfident. Overconfidence is the belief that your forecasts are more accurate than they are. It leads to excessive leverage. Leverage is borrowed exposure that magnifies gains and losses. Leverage feels efficient in calm periods. It becomes fatal in regime shifts. A regime shift is when the market environment changes, like going from low volatility to high volatility, or from abundant liquidity to scarce liquidity. Liquidity is the ability to buy or sell without moving the price much. In good times, liquidity hides risk. In stress, liquidity disappears and correlations jump. Correlation is how much assets move together. People diversify. They think they are safe. Then a crisis hits and everything drops at once. That is not bad luck. That is the psychology of crowds combined with forced selling. When investors panic, they sell what they can, not what they want. That pushes correlations toward one. Long-term capital management is the cleanest case study for this. LTCM had brilliant people and sophisticated models. Their models relied on historical relationships and on the idea that spreads would converge. Convergence trades often have small, steady gains and rare, large losses. That is negative convexity. Convexity is how your payoff changes as the world moves. Negative convexity means you bleed small profits, then you get hit hard in the tail. Tail risk is the risk of extreme outcomes. In 1998, Russia defaulted, volatility exploded, correlations changed, liquidity vanished, LTCM was levered. The trades that were supposed to be diversified became the same trade. The psychology here is subtle. When you have been right many times in a row, you start to believe you are right by nature. You size up. You stop imagining the tail. Now look at Barings and Nick Leeson. This was not a genius model problem. It was a control problem and an incentive problem. Controls are the checks that stop a trader from hiding losses or increasing risk without oversight. Failure modes are the ways a system breaks under stress. Leeson was able to both trade and handle back-office functions, which is a segregation failure. He hid losses. He doubled down. Doubling down is a psychological move. It is the need to get back to even. Getting back to even is one of the most dangerous goals in finance because it pushes you to take asymmetric risk. Asymmetric means the downside is larger than the upside. In that state, you are not trading. You are bargaining with reality. I want you to notice something. Both LTCM and Barings were not just about bad forecasts. They were about human behavior under pressure and about systems that allowed that behavior to compound. Most retail trail traders think psychology means staying calm. That is part of it. But the deeper level is building a process that does not require heroism. Process is how you make decisions repeatedly. If your process depends on feeling confident, you will break it. Confidence is not stable. Sleep, stress, money, and ego change it. A robust process assumes you will feel fear and greed, and it designs around that. This is where expected value matters. Expected value is the average outcome if you could repeat the same decision many times. A trade can have positive expected value and still lose today. A trade can have negative expected value and still win today. Your brain learns from today. Markets pay you based on the long run. That mismatch creates emotional learning errors. If you take a bad trade and it works, you get reinforced. If you take a good trade and it loses, you get punished. Over time, you can train yourself into worse behavior. This is why I like to think in base rates. Base rates are the historical frequencies of outcomes in similar situations. Base rates are not perfect, but they anchor you. When you ignore base rates, you replace them with stories. Stories feel true. Stories are often just narrative glue. George Soros is famous for reflexivity. Reflexivity means beliefs can change prices, and prices can change beliefs, creating feedback loops. In bubbles, price rises create confidence. Confidence creates buying. Buying creates more price rises. The psychology is contagious. You start to feel stupid for not participating. That is social proof. Social proof is when you assume something is correct because many people believe it. In markets, crowds can be right for a while and still be wrong in the end. The dot-com bubble is a clean example. Many smart people saw valuations that made no sense and still felt pressure to own the winners. Career risk is real. Career risk is the risk of looking wrong relative to peers. It pushes professionals to herd. Retail traders have a version of it too. It is the fear of missing out and the fear of being the only one not making money. That fear can override risk limits. Warren Buffett is often used as a symbol of patience. The psychological edge there is not mysticism. It is temperament and time horizon. Time horizon is how long you can wait for an idea to work. A longer time horizon can reduce the noise you have to endure, but it also requires the ability to sit through drawdowns without changing your thesis every week. Charlie Munger talked about avoiding stupidity. I take that as risk management. Avoiding big errors beats chasing perfect decisions. Paul Tudor Jones is known for respecting the tape and cutting risk. I am not quoting him. I am pointing to a principle that shows up in many great traders. They treat survival as the first job. Survival is not just avoiding bankruptcy, it is avoiding the kind of loss that changes your behavior. That is risk of ruin. Risk of ruin is the chance you lose so much that you cannot continue. If you cannot continue, your edge does not matter. This is where the Kelly criterion comes in, with a big warning label. Kelly is a formula for optimal bet sizing to maximize long-run growth based on edge and odds. In practice, your edge is uncertain, your odds shift, and your estimates are noisy. So full Kelly can be too aggressive. Psychologically, too aggressive sizing creates emotional volatility. Emotional volatility is the swing in your mood and judgment. When emotional volatility rises, you abandon your plan. I see the same pattern across traders. They think the problem is picking entries. The bigger problem is what they do after entry. They move stops. They add to losers. They take profits early. They freeze. They avoid looking. Avoidance is a psychological defense. It feels safe. It is expensive. So I focus on one question. Can I hold my risk steady when I feel the urge to change it? If the answer is no, the position is too big, or the strategy is not understood, or the time frame is too fast for my temperament. There is also the issue of attribution. Attribution bias means you credit wins to skill and blame losses on bad luck. That keeps your ego safe, but it blocks learning. A trader needs a clean feedback loop. Clean feedback means you can separate decision quality from outcome. You can say, this was a good trade that lost, and this was a bad trade that won. If you cannot say that, you will drift. I want to land this in something practical and human.